Welcome back to the podcast, Yves. We're diving deeper into automating trading operations, and it's fascinating how this book, Python for Algorithmic Trading, approaches the challenge. The quote about computers being too stupid to not have already taken over the world is a great starting point. So, what's the practical takeaway from this chapter?
Yeah, it's a bold statement, but it highlights the complexity of the issue. Essentially, the chapter's about taking all the pieces of a trading strategy, historical data, streaming data, order placement, account checks, and the algorithms we've already discussed, and stitching them together for automated trading. It's not a one-size-fits-all solution.
Right. So, we're not just talking about writing a single program and having it execute perfect trades?
Precisely. This chapter assumes a single focus strategy for simplicity that allows us to focus on capital management, risk management, which are crucial, backtesting, translating our offline algorithm into something that can handle real-time data, and then finally deploying it robustly.
Let's break down those topics. Capital management, the Kelly criterion. Can you explain how this helps with sizing trades?
The Kelly criterion is a formula that helps determine the optimal trade size based on the strategy's expected return and risk. It factors in the specific characteristics of the strategy and the capital available. It's about finding the right balance between maximizing potential gains and minimizing potential losses for this particular strategy.
Makes sense. And backtesting is crucial. You mentioned that.
Absolutely. Before deploying any automated strategy, you need to thoroughly backtest it across a significant historical period. This lets us see how well the strategy would have performed in the past and what its risk profile is, how volatile it was.
That's super important. What about the ML-based trading strategy example? What kind of algorithm are we looking at, and what does backtesting entail?
This example likely uses a classification algorithm from machine learning. You might be looking at things like support vector machines, decision trees, or perhaps a neural network. The chapter emphasizes using the results of backtesting to evaluate both performance, how much money was made or lost, and risk characteristics, how big were the swings in the strategy's portfolio value.
Okay. So, you're translating the algorithm into an online algorithm, which has to work with incoming data. What exactly does that transformation involve?
Well, the offline algorithm operates on historical data, but the online algorithm has to adapt and respond to new incoming data in real time. This often involves adjusting parameters dynamically or continuously updating the model with new information. Think of it as keeping the strategy responsive to market changes.
Infrastructure and deployment. This must be a complex part. Cloud seems like the obvious answer. Why is that?
Absolutely. Cloud deployment offers the scalability, performance, and security that automated trading strategies need. You don't have to worry about managing physical servers or infrastructure.
Excellent point. And finally, logging and monitoring. This is something I think a lot of people overlook.
It's critical for debugging and understanding how the strategy performs in real-world conditions. Logging allows analysis of historical events during deployments. Monitoring, with socket communication as introduced earlier, gives you real-time visibility into the strategy's activity.
Great summary. So, it really sounds like the chapter is about taking a well-defined strategy, thoroughly vetting it, implementing it online, and then making sure that whole system is reliable and observable in the cloud.
Exactly. It emphasizes the holistic approach, strategy design, validation, implementation, deployment, and monitoring, all key to successful automated algorithmic trading.
Welcome back to the show, Yves. We're diving deeper into algorithmic trading, and today we're specifically looking at capital management. So, one of the fundamental questions, right? How much capital do you allocate to a given strategy?
Absolutely, Matthew. It's a crucial aspect. It's all about, finding the optimal balance between risk and reward. And the goal, as you mentioned in the introduction, is typically to maximize long-term wealth. That's the driver for most strategies, individual traders, and even large institutions.
Right. And you mentioned the Kelly criterion. Can you unpack that a bit for us? What's the significance of the Kelly criterion in capital management?
Sure. The Kelly criterion, developed by Edward Thorpe, provides a framework for calculating the optimal fraction of your available capital to deploy into a specific trading strategy. It's based on the strategy's statistical return characteristics. It's not about trying to time the market or predict future returns perfectly. Instead, it leverages the historical data of the strategy to find the optimal capital allocation ratio.
So, it's all about historical data analysis then?
Precisely. You look at the past performance, win rates, average profit/loss of a particular strategy. Based on these, you can determine the optimal proportion of capital to invest. This proportion is not a random figure. It is calculated with mathematical rigor, essentially finding the best balance for expected returns while limiting risk.
How does this relate to the overall risk-reward profile of a strategy?
Well, the Kelly criterion aims for the highest possible growth rate while adhering to the principle of maximizing returns over the long term. This, of course, depends on the strategy you are deploying. The Kelly criterion doesn't consider market timing and external factors which may affect the returns of the strategy. Therefore, it's crucial to remember that it's just a statistical measure, and it doesn't guarantee success. It's a tool for rational decision-making within a trading system given its statistical history.
So, if a strategy has a consistent win rate and profit/loss profile, the Kelly criterion would offer a more reasoned allocation of capital.
Exactly. It provides a structure for making decisions, helping you understand your strategy's mathematical potential for growth, something very important in algorithmic trading. You could even adjust the proportion to reflect the risk tolerance, right? If you're comfortable with more risk, you might allocate a larger portion to a particular strategy.
This is fascinating. So, the Kelly criterion isn't about predicting the future, but about optimizing your resource allocation for a specific strategy given its historical performance?
Absolutely. It's a powerful tool for quantitative analysis within a trading system, a mathematical framework to guide decisions about capital deployment.
Welcome back to the show, Yves. We're diving deeper into the Kelly criterion now, specifically in a binomial setting using Python simulations. This is fascinating stuff. Can you give us a quick recap of what the Kelly criterion aims to achieve in this context?
Sure, Matthew. The Kelly criterion, in a nutshell, helps us determine the optimal fraction of our capital to bet in a repeated game, like a coin toss. Instead of betting everything on one go, which can quickly lead to ruin, the Kelly criterion finds the bet size that maximizes the long-term average geometric growth rate of our capital. It's all about sustainable growth, not just chasing quick wins.
Got it. So, we're not just interested in the expected value of a single bet, but the expected growth over many trials?
Exactly. The key insight is that in repeated games, a smaller strategic bet that preserves capital over many trials will likely yield greater long-term returns than going all in on a single bet. The chunk lays out how this optimal fraction, f***, is derived mathematically, using logarithms and expected values. The code we looked at then uses this formula to simulate how different fractions affect capital growth over a series of trials.
Okay. And what's crucial about the probability P and its complementary probability Q in this context?
Well, the probability P, the probability of getting heads, for instance, is absolutely fundamental. If it's higher than 0.5, it's favorable to bet on heads. The Kelly criterion calculates the optimal fraction f*** based on the difference between those probabilities, PQ. The higher this difference, the greater the potential for long-term gains. If P is significantly different from Q, the optimal fraction will be larger.
So, the optimal fraction f is directly tied to the difference between the probabilities of the outcomes?
Absolutely. The simulation section in the chunk shows how this translates into Python code. They initialize capital, simulate a large number of coin tosses, and track the capital's growth over time for varying values of f. The critical part is the simulation loop. They use np.random to binomial 1p to simulate coin flips, increasing or decreasing the capital based on the outcome. Crucially, you can run the simulation for different values of f to see their impact on the trajectory of the average capital, which is also what Figure 10.2 visualizes.
This is really helpful. What about the different simulations where they use different values for f? What insight do they give us?
The simulation results, shown in Figure 10.2, are key. They highlight how the optimal bet size, f, is directly related to the long-term growth of capital. A well-chosen f provides a stable and predictable growth trajectory. You can see that an inappropriate fraction, like f equals 0.5, for example, can result in a much lower average capital in comparison, despite the initial potential for gains.
This highlights the balance between risk and reward, doesn't it?
Exactly. You have to find the appropriate risk-reward balance for maximizing long-term wealth. Too aggressive a bet will lead to eventual ruin, while a too conservative strategy may miss out on substantial gains. The Kelly criterion helps us find that happy medium for sustained success.
This is really insightful, Yves. Thanks for breaking down these concepts for us. Welcome back to the podcast, Yves. We're diving deeper into Python for algorithmic trading, and today we're exploring the Kelly criterion. So, we were just talking about this fascinating concept, the Kelly criterion, and how it helps optimize investment strategies in stock markets. And this section is all about applying it to a stock or an index. Can you help unpack the core idea here?
Absolutely, Matthew. The Kelly criterion essentially aims to find the optimal fraction of your capital to invest in a particular asset, like a stock or an index fund. It's all about maximizing the long-term growth rate of your portfolio. Key here is understanding that the goal isn't just to make a quick profit, it's about sustainable, compounding returns over time.
Right, so it's not just about picking the asset with the highest possible return, but about the best mix with your existing capital. Can you elaborate on the binomial model used here?
Sure. The model simplifies the stock market to two possible outcomes after a year. It's a simplified representation, but it's a good starting point for understanding the underlying logic of the Kelly criterion. Instead of a complex range of potential returns, we're assuming only two scenarios with probabilities that are crucial for determining how much risk to take. We have to understand the stock market's volatility, how much the prices fluctuate. The expected return and its volatility are essential to determining the optimal investment strategy using the Kelly criterion.
Got it. And this optimal fraction, the F*, is directly tied to these expected returns and volatility. Is it calculated differently depending on the number of trading days?
Yes, the formula for F** considers the yearly time frame, but the way we deal with the daily data is also crucial. The volatility scales with the square root of the number of trading days. The crucial concept is that daily returns are combined to give you a yearly return. The formula we're looking at considers the daily values scaled to yearly values in order to give you the optimal daily fraction, F, to use in this strategy. That's why these daily observations are taken into account in this calculation.
Okay, that makes sense. So, the formula for F** is essentially a ratio of the expected excess return over the risk-free rate to the variance of returns. How does this differ from the Sharpe ratio?
The Sharpe ratio measures risk-adjusted return, but the Kelly criterion focuses on maximizing the expected geometric growth rate. The Sharpe ratio compares returns to a benchmark, often the risk-free rate. The Kelly criterion is more focused on what's the best way to use your capital to maximize returns based on your assumptions of the returns.
So, this Python code, how does it practically implement this strategy?
The Python code you see there's essentially taking the optimal fraction, F***, or some fraction of it to apply the Kelly criterion. It's simulating the performance of different investment strategies, so you can see how much investment results change based on the optimal fraction of investment. It calculates the equity, the value of your invested capital, and tracks how that evolves over time compared to the index itself, showing the effect of the leverage built in by the strategy. It effectively calculates the optimal fraction based on the volatility and expected return, and then it continually adjusts the amount of money invested depending on the returns from the previous days.
That's insightful. And the code starts with a baseline, investing $1, or an amount, based on that fraction, and it adjusts that based on gains and losses. So, by continuously readjusting the portion of your portfolio based on the previous day's returns, this strategy leverages the best potential return and adjusts according to risk.
Exactly. The simulation shows how much the equity will increase, and this is adjusted daily based on the fraction F. Lower fractions, like half Kelly, provide a more stable and less volatile equity trajectory. Higher leverage, which is full Kelly, is highly volatile, which often is a reason for caution.
Excellent. So, the Kelly criterion, while theoretically optimal, in practice is a balance between expected return, volatility, and potentially higher risk depending on how much of your total capital is leveraged. You've covered a lot there. Thanks, Yves.
My pleasure, Matthew. Always a good discussion.
Welcome back to the podcast, Yves. We were just discussing the overall approach to algorithmic trading strategies, and now we're diving into a crucial part of the process, using machine learning for these strategies. Can you elaborate on how Chapter 8 in the book specifically tackles this? using the OANDA platform?
Sure, Matthew. Chapter 8 builds upon the foundation we laid in previous chapters, focusing on the practical application of ML-based trading strategies. It introduces the OANDA trading platform, highlighting its RESTful API, and how Python wrappers like TPCoA make interacting with it seamless. Essentially, you're connecting your Python code to the OANDA platform to fetch real-time market data for euro to US dollar.
So, it's about connecting the ML model to the real financial market. That's a key step. What about the ML prediction itself? How is the direction of the price movement predicted in this context?
The chapter employs a machine learning model to analyze historical data, attempting to identify patterns and predict future price movements. Crucially, it's not just about predicting the direction, it's about building a predictive model that can be integrated into a trading strategy. This model is built on historical data, which is crucial, and then tested via backtesting.
You mentioned backtesting. Can you elaborate on how this backtesting is implemented in the context of the OANDA API and the TPCoA wrapper? Does it account for important factors like bid-ask spreads?
Absolutely. The backtesting process is crucial because it evaluates the strategy's performance in a simulated market environment without real risk. A critical addition here is the consideration of bid-ask spreads as proportional transaction costs. Using the TPCoA wrapper, historical bid and ask prices for euro to US dollar are readily available to be considered, unlike earlier chapters where this aspect may not have been explicitly addressed. The backtesting, thus, simulates the actual trading environment more accurately by factoring in these costs.
Interesting. And how does this approach differ from the vectorized backtesting approach introduced in Chapter 4?
The vectorized backtesting approach in Chapter 4 provides a foundational understanding, but Chapter 8 takes it further. It goes beyond a basic evaluation of the strategy's profitability. It deep dives into the risk characteristics of the trading strategy. The analysis now considers more factors like the volatility of the returns, the drawdown, and other crucial risk metrics to provide a comprehensive understanding of the potential risks associated with the trading strategy. This is crucial to ensure a balanced approach to risk management and the avoidance of potential large losses.
That's a crucial distinction. So, this updated method gives us a more comprehensive picture of risk, while still making use of the efficient vectorized backtesting. How would you advise someone implementing this type of strategy?
I'd recommend a methodical approach. Start with identifying suitable historical data for the model, making sure that the data accurately reflects the market conditions at that time. Then, carefully select the machine learning model and refine its parameters through iterative tuning and validation using different datasets. A key takeaway is to constantly assess the strategy's performance against multiple risk criteria, such as the potential maximum drawdown and standard deviation of returns, to optimize for robustness and profitability.
Welcome back to the podcast, Yves. We were just discussing vectorized backtesting, and it seems like a powerful approach. Can you elaborate on the process of retrieving the intraday data?
Sure, Matthew. We're using the OANDA v20 API, which is a popular choice for accessing financial market data. The code snippet you saw connects to that API. Importantly, it's pulling 10-minute bar data for a specific instrument, euro to US dollar in this case, over a week in 2020. That's crucial for intraday analysis, because it focuses on short-term price movements.
Okay, so it's downloading the closing prices every 10 minutes. What are the key steps in setting up this backtesting environment?
Well, the crucial part is specifying the time frame. The code clearly defines the start and end dates, June 8, 2020, and June 13, 2020, and the data granularity, M10 for 10-minute bars. Then, it gets the mid-closing price, which is often a useful measure in the markets. The code stores this data in a pandas data frame, which is a very powerful tool for structured data manipulation in Python, simplifying the process of analysis.
Got it. The next step, I understand, is calculating different time series features. Why is that necessary?
Absolutely. To make the machine learning model work, you need to feed it relevant data.
So, lagging the data means creating new columns that represent earlier values of these indicators. That makes sense for a time series-based approach. What's the significance of calculating proportional transaction costs?
Exactly. The code calculates the average spread between the bid and ask prices, which is a measure of market liquidity and how much it costs to execute a trade. Then, it calculates a mean closing price to get an average proportional transaction cost, PTC. This is crucial for realistic backtesting, unlike fixed transaction costs, because it mirrors the actual cost of executing trades.
How does this influence the overall calculation of the trading strategy's profitability?
The code calculates the returns for the trading strategy and then subtracts the transaction cost wherever there's a position change. This is the strategy TC column. Then it looks at the cumulative sum of returns for each scenario, with and without transaction costs, compared to just the passive benchmark investment, to measure how the trading strategy performed. Figure 10.5 in the text visually displays these results.
This is fascinating. So, we're comparing the performance of the strategy with and without considering transaction costs, right?
Exactly. The difference in the cumulative returns reflects the impact of transaction costs, giving a clearer picture of the strategy's true profitability. This vectorized approach is useful for testing and comparing different strategies on historical data, but it does have limitations, especially when you start to look at fixed transaction costs per trade.
Very helpful use. We're getting a much better understanding of the vectorized backtesting approach. Thanks for your insights. Welcome back to the podcast, Yves. We're diving deeper into Python for algorithmic trading, and today we're looking at optimal leverage, specifically using the Kelly criterion. Can you break down how this calculation works and what the code snippet is showing us?
Sure, Matthew. Optimal leverage is crucial because, it directly impacts risk and potential returns. The Kelly criterion, a fundamental concept in mathematical finance, basically helps us figure out the best leverage to use, given our trading strategy's historical performance. It aims to maximize long-term returns while controlling risk.
Okay, so the code, as I understand it, calculates the annualized mean, return, and variance of the trading strategy. Can you explain why annualizing these values is important and how it doesn't change the optimal leverage result?
Right. Annualizing, essentially standardizes the data to a yearly time frame. It's important because it allows us to compare the strategy's performance across different periods with varying lengths. Importantly, the mean return and variance scale proportionally with the time period. So if you multiply the mean return and variance by a factor, the optimal leverage calculated using the Kelly criterion stays the same. It's a nice property that simplifies the process.
Interesting. So, it's not about the magnitude of the return, but the relationship between return and variance.
Exactly. The code snippet then uses these annualized values to compute the optimal leverage. Crucially, it calculates both the full Kelly and the half Kelly leverage. The difference is in the portion of the return that gets used in the leverage calculation. Full Kelly uses the entire mean return, while half Kelly uses half of it.
Ah, that makes sense. And the output shows the annualized mean return, annualized variance, and the calculated optimal leverage figures.
Well, the annualized values help us understand the strategy's expected performance on an annual basis. The calculated leverage values indicate the level of risk and reward we're accepting. The output, specifically, shows us the optimal leverage values for both full Kelly and half Kelly. The output also indicates that the optimal leverage for the half Kelly criterion is quite substantial, greater than 50. This is significant because, while higher leverage amplifies returns, it also drastically increases the risk of significant losses.
So a leverage value above 50 for half Kelly is quite high. What are the potential pitfalls, and what are the crucial considerations traders should have in mind?
Absolutely. Leverage is a double-edged sword. High leverage can magnify profits, but also losses. Traders need to be very aware of the risk management aspects. Brokers, especially, impose leverage limits for retail traders. Regulations often vary by financial instrument. The example, showing the performance of the trading strategy under varying leverage values, highlights this directly. We see a significant impact of leverage on the cumulative returns, especially over time. It's important to remember that past performance is not indicative of future results, as mentioned in the text. It's extremely important to thoroughly assess risk tolerance and understand the specific regulations and disclaimers.
This is super helpful, Yves. Thanks for clarifying the concepts and implications of optimal leverage and the Kelly criterion in algorithmic trading. All right, Yves, we're diving deeper into risk analysis now, specifically looking at leverage. This chunk is really interesting because it's showing how to calculate maximum drawdown and longest drawdown period. Could you unpack how these metrics are calculated and why they're crucial for algorithmic trading strategies?
Sure, Matthew. Maximum drawdown, is basically the largest loss from a recent peak in a trading strategy's equity curve. And the longest drawdown period measures how long it takes for the strategy to recover to that peak. Crucially, this helps us understand the downside risk a strategy is exposed to. Imagine a strategy that has a huge peak and then crashes. These metrics help quantify how far it drops and how long it takes to get back up, which is extremely important for portfolio managers and investors. It's really about understanding the potential for substantial losses and how quickly the strategy might recover.
Okay, so you're saying that this is a way to measure the resilience of a trading strategy?
Exactly. And the code snippets here demonstrate how to calculate these metrics using Python and pandas. It starts by loading the relevant data, which in this case is likely log returns of the leveraged trading strategy. Then, it calculates the cumulative maximum equity values over time. This crucial step allows us to establish benchmarks against which we assess the drawdowns. Then, the drawdown is calculated by subtracting the current equity value from the cumulative maximum. This difference represents the loss since the recent peak. The code finds the maximum drawdown and identifies the timestamp when that maximum occurs. This timestamp pinpoints the exact point in time of the largest loss.
Right, and the code then looks at the points where the drawdown is 0, indicating a new high. It calculates the time difference between these highs to determine the length of each drawdown period. This is how we establish the duration of the time it takes to recover. So, we get these time periods that show us how long it took the strategy to return to the peak.
Correct. It gives us a specific numerical measure of the longest drawdown period, which is then converted into hours for easier interpretation.
Excellent. And it moves on to another crucial risk measure, value at risk, VAR. How is VAR calculated in this context? And what's the significance of the different confidence levels?
VAR, or value at risk, estimates the maximum potential loss over a specific time frame with a given level of confidence. In this case, the code calculates VAR using different confidence levels, like 90%, 95%, 99%, etc. These confidence levels show the probability of not exceeding the expected loss. For instance, a 95% confidence level VAR means that there's a 5% chance of the loss being greater than the calculated VAR. So, if we see the VAR values for different confidence levels for 10-minute and 1-hour time intervals, we get a much more complete picture of the risk. This crucial information allows us to understand the potential loss a strategy might experience, and how likely such a loss might be to occur. For example, if the strategy frequently has VAR values exceeding a certain level of loss, that suggests potential issues with the strategy's risk management.
So essentially, we're looking at potential losses at different confidence intervals and time horizons. The code then resamples the data to 1-hour intervals, effectively increasing the VAR value for all confidence levels. This is because the potential for loss tends to increase when the time horizon increases. This further underlines how crucial it is to consider a strategy's behavior over multiple time intervals, not just a single one.
Exactly, and the higher the confidence level, the higher the VAR will be, reflecting that there's a higher probability of suffering a loss of that magnitude or greater. In the provided example, you can see how the VAR values differ across different confidence levels and time horizons, highlighting the need to have a multifaceted understanding of potential losses. The numbers themselves need careful contextualization against the trading strategy itself.
So, Yves, we were talking about persisting this model object. This is a crucial step, right? Once we've backtested our algorithmic trading strategy, we want to save it for later deployment, so we can use it in a live trading environment. Can you elaborate on the practical implications of this?
Absolutely, Matthew. Persisting the model object means saving the trained machine learning model and any associated parameters that are essential for the algorithm to function. Think of it like saving a recipe after you've perfected it. You don't want to recreate the entire process every time. This way, you can easily load it in your deployment environment.
Okay, that makes sense. And this chunk shows us how to do that using Pickle, right?
Yes. We're using the Pickle module, which is a really handy tool for serializing Python objects. It allows us to convert complex data structures, like the model object, mu, and std, which I assume are statistical parameters, into a format that can be stored in a file. It's pretty straightforward.
So, we're creating a dictionary called Algorithm. What exactly goes into that dictionary?
Right. The algorithm dictionary holds our key components for trading. It essentially stores all the crucial data needed to reproduce the trading strategy. Crucially, it puts the trained machine learning model and the parameters like mu, mean, and STD, standard deviation, into one easily retrievable package.
So, the model, mu, and STD are components of the algorithmic strategy? Why are those particularly important to save?
Exactly. The model object is the heart of our machine learning trading strategy. Mu and STD are likely statistical figures derived from data used to train the model.
And then we use pickle.dump to save this entire package, the algorithm, into a file called algorithm.pkl. Is there a particular reason why pkl?
Well, it's a common convention to use .pkl for pickle files. It's a standard way to indicate that this file contains a pickled Python object. It's a good practice to follow these naming conventions so that you and other developers know what kind of data is in the file and how to handle it.
Okay, so we're essentially creating a snapshot of our trained algorithmic trading strategy.
Exactly. We're freezing the state of our strategy at a specific point, allowing us to quickly and easily load it into another environment later on.
Fantastic, Yves. This makes complete sense now. So, we can quickly load up this pickle file later, and our trading strategy is ready to use. Welcome back to the show, Yves. We were just discussing how to transition from an offline trading algorithm to an online one, specifically within the context of financial markets. So, we've moved from using a complete data set to processing data as it arrives, which is crucial in real-time trading. Could you elaborate on the challenges unique to online algorithms?
Absolutely, Matthew. The key difference, as we discussed, is the continuous flow of data. Offline algorithms have the luxury of analyzing everything at once, training and optimizing.
Right, real-time data processing is critical, and we see that reflected in the code you've presented. Can you unpack the code snippet where the offline algorithm is converted into an online one?
Sure. The ML Trader class inherits from the tkoa.tkoa class. This essentially means it leverages the OANDA API interaction functionality that we talked about last time. The __init___ method sets up the parameters for our online algorithm, which are crucial for adapting the algorithm to the online environment. This includes loading the trained model, self.model, normalization parameters, self.mu, self.std, trade volume, self.units, and initializing the position, self.position. It also defines variables like the bar length, window size, number of lags, and feature selection criteria.
So, these parameters are crucial for handling real-time market conditions, right? Why is it important to set the min_length variable?
Correct. Min_length is critical because before we can make a trade, we need sufficient data to generate the required features. If there isn't enough data for our window and lags, we can't execute trades reliably. The min_length ensures our algorithm doesn't act on incomplete or insufficient information. The calculation also keeps the window size and lags in sync with the data length. The incrementing min_length after successful analysis is also crucial to accommodate expanding lookback periods.
In the prepare_features method, how does it work in real time?
This method calculates time series features like return SMA, simple moving average, min max, vol volume, and ma momentum from the incoming tick data. Crucially, it uses rolling calculations on the data to get the most recent window of information. It's essential that all calculations happen in real time. Then it normalizes these features using the saved mu, mean, and STD, standard deviation values learned during the offline training phase. It then lags these features to consider historical context.
The on_success method is where the magic happens. Could you walk us through how this part of the online trading algorithm works?
The on_success method handles incoming tick data. It appends the new tick data to a data frame, resamples it according to the defined bar length, and calculates the midpoint mid-price. After these necessary operations, it prepares the features and then makes predictions using the previously loaded model. Crucially, it checks if there's enough data, determined by min_length. And if so, it generates a signal based on the model's prediction. It then decides whether to open a long or short position, placing an order accordingly and updating the current position.
So, the process is taking incoming data, calculating features, making predictions, and then executing trades based on the prediction? That makes a lot of sense. Thanks, Yves. Welcome back to the show, Yves. We're diving deeper into the infrastructure needed for algorithmic trading strategies. So, you mentioned that deploying with real money requires a robust infrastructure. Can you elaborate on the key elements of reliability, performance, and security that need consideration?
Absolutely, Matthew. Reliability is paramount. You need an infrastructure that's highly available. Think 99.9% uptime or better. That means automatic backups, redundant hardware, and crucial, redundant internet connections. You can't afford downtime in real-time trading. Any hiccup, even a momentary one, could lead to significant losses.
Okay, that makes sense. Performance is another big piece, right? How critical is processing speed, and what about storage?
Absolutely. The speed and efficiency of the infrastructure depend heavily on the algorithm's computational demands and the volume of data being processed. You need ample CPU cores, RAM, and high-speed storage, SSD. A slow processor or insufficient RAM can significantly hamper the performance of your trading strategies, potentially leading to missed opportunities or delayed trades. High-speed internet connections are essential for real-time data feeds. They need to be very responsive.
And then there's security. How can we protect against various threats?
Security is critical. You need strong passwords, robust encryption, SSL, and data protection measures like hard drive encryption. Protecting the hardware itself from physical threats like fire, water damage, and unauthorized access is also essential. It's not just about software, you need physical safeguards in place. And of course, consider the security of the operating system, the applications, and any sensitive data related to your trading strategies.
It sounds like renting from a professional data center or a cloud provider is the obvious solution for most traders, especially smaller or mid-sized ones. Can you elaborate on why dedicated physical infrastructure isn't feasible for most?
Precisely. The upfront costs and ongoing maintenance of a dedicated physical infrastructure are usually prohibitively expensive for individual traders or smaller firms. Data centers and cloud providers offer the scalability, flexibility, and reliability needed for a reasonable cost. Bigger players might justify a dedicated infrastructure because of the massive scale of their operations and potential returns, but, for the vast majority of us, cloud solutions are much more practical.
You mentioned cloud providers like DigitalOcean. What's the appeal of a smaller cloud instance like a droplet for development and testing?
Well, for developing and testing your strategies, a smaller droplet is more than sufficient. It's cost-effective and gives you the flexibility to quickly spin up and destroy virtual machines as needed. The cost of a DigitalOcean droplet is minimal, about $5 per month, and that flexibility really speeds up the development cycle. You can easily adjust and experiment without significant financial risk. And those bash scripts you mentioned? They are essential for automating the configuration of the droplet to match your Python packages and preferences.
So, even though a droplet works for development, trading with real money demands significantly more sophisticated infrastructure. That makes perfect sense. Thanks for clarifying these vital details about infrastructure and deployment, Yves. Welcome back to the show, Yves. We're diving deeper into Python for algorithmic trading, and now we're looking at deploying our strategy on a remote server. What are the key considerations for algorithmic traders who don't want to be glued to the screen?
Absolutely, Matthew. This is a crucial aspect. You've got to have logging and monitoring in place, if you're not sitting in front of the server 24/7. Logging, as you know, records events and data for later analysis. In this context, it's critical for capturing financial data, the trades, the outcomes, the market conditions, everything relevant to the strategy's performance. This makes it easier to debug, spot trends, and understand what's happening even when you're not actively watching.
In real-time monitoring? How does that fit in?
Real-time monitoring complements logging beautifully.
Instead of just having a historical record, it gives you a live stream of critical financial information. Think of it as a constant update, a sort of heartbeat of your trading system. This is often done via socket communication, using a technology like 0MQ in this case. This allows you to capture the data in real time and then send it over to a local machine for processing, even if your trading strategy runs entirely on a remote server in the cloud.
So, we're talking about using 0MQ to create a constant data stream. Can you elaborate on how that stream looks in practice? What kind of information is being sent?
Sure. The example shows the output of the data being logged. It's not just raw numbers. It includes things like the number of ticks and bars processed, the most recent data points, and some key features your algorithm uses. You'll see timestamps, crucial for tracking the timing of events. The example also shows a range of data, price changes, return lags, and importantly, signals your algorithm is producing. The script also captures information about any trades that have been placed. For instance, the data stream displays information like the type of order, market order, the amount of units traded, the price, the profit or loss, commission, the balance after the trade, and details about the closed trades, including ID, price, units traded, profit.
That's a rich data stream. How do you then work with this information off the remote server?
The example details how the data is being sent. There's a separate monitoring script that you'd run locally to receive these updates and process them. You could use this to plot the data, generate insights, or perform other analysis to determine the strategy's performance. The script is designed to be flexible so you can adapt the logging and streaming to your specific needs and, tailor the monitoring scripts for specific tasks.
Great. You mentioned stop loss and take profit targets. Can these be incorporated?
Absolutely. This is where the flexibility of the Python scripts becomes very important. The core logic can be adapted to include programmed stop loss and take profit orders. You could modify your automated trading logic within the scripts, based on the data streaming from the remote server, to trigger these orders automatically.
So, this isn't just about recording events. It's about building a complete feedback loop, receiving live information, and reacting programmatically. What are some of the potential risks with automated trading strategies like this?
Exactly.
Welcome back to the podcast, Yves. We're diving deeper into Python for algorithmic trading, specifically looking at practical applications. We've established the importance of the FXCM and OANDA platforms, but now we're shifting our focus to a visual step-by-step guide. Can you tell us a bit about this visual overview and why it's important, given it's based on the OANDA platform, not FXCM?
Sure, Matthew. Well, this visual step-by-step is crucial for practical understanding. While the earlier discussions focused on FXCM, this segment is designed to bridge that gap and provide visual clarity for traders using OANDA. Different platforms have slightly different user interfaces, and this is important for understanding those nuances.
So, it's like a visual translation almost? How does that translation manifest in this visual overview?
Exactly. It's a visual representation of the process, showing each step, practically. It's not just
Okay, so this detailed visual step-by-step focuses on the actionable steps using the OANDA platform. Is this visual overview directly tied to the programming language or the specific strategies we've discussed in previous chunks?
Well, that's a key point. This visual guide is tightly connected to the strategies, but rather than the programming itself, it demonstrates the practical application of those strategies within the OANDA trading platform. Imagine you've already written your Python code. This shows you how to integrate it with the OANDA interface in a step-by-step, practical way. It's about how the Python code connects and communicates with OANDA to trigger trades, execute orders, or pull data. The process is visualized through each screen capture, almost like screenshots showing each dialog box you need to interact with, and each relevant button or control you must navigate through on the OANDA platform. Hopefully, that clarifies the key difference.
That's really helpful. So, you're highlighting how to connect the Python algorithms to the OANDA trading platform, showing the vital steps required for integration. It's a practical, platform-specific application rather than abstract coding itself. Are there any particular nuances of the OANDA interface that this visual guide emphasizes?
Absolutely.
Excellent. This is incredibly practical advice. By presenting the application visually, it's much easier for someone to grasp the crucial connections between the Python code and the OANDA environment. Thanks for clarifying the nuances. Welcome back to the podcast, Yves. We're diving deeper into Python for algorithmic trading, and today we're specifically looking at setting up a trading account. Specifically, we're talking about OANDA. You've touched on a lot of the crucial coding aspects, but setting up the actual trading platform is equally important. Can you elaborate on the importance of account configuration, particularly the leverage ratio, for algorithmic trading strategies?
Yeah, absolutely, Matthew. Setting up your account, like choosing OANDA or any trading platform, is a critical first step. It's not just about opening an account. You need to understand the specific parameters, like the leverage ratio. Leverage, in essence, amplifies your potential profits and losses. A higher leverage ratio means you can control a larger position with a smaller initial investment, but that also means you're exposed to greater risk.
So, how does this leverage ratio specifically affect an algorithmic trading strategy?
That's where the Kelly criterion comes in. It's a very important concept when choosing your leverage. The Kelly criterion basically tells you the optimal proportion of your capital you should risk on any given trade. It's all about maximizing long-term gains while minimizing your chances of ruin. Essentially, you want a leverage ratio that aligns with your expected return rate and your risk tolerance, given your specific trading algorithm.
And what's the role of Figure 10(8) in this process? How does it visually demonstrate the proper leverage setting?
Figure 10(8), likely from the book you mentioned, would visually show how leverage is selected based on a few factors, and those factors are key to understanding the optimal leverage ratio that aligns with the trading strategy. It probably plots leverage against some metrics, like expected return on investment or your win rate. The aim is to find the sweet spot that maximizes the long-term returns while minimizing the risk of losing your capital. The specific details depend on the exact strategies being used.
You mentioned risk tolerance. How do you practically incorporate risk tolerance into this process? I mean, for different algorithmic trading strategies, the optimal leverage might vary considerably, right?
Absolutely. Different algorithms will have different risk profiles. If an algorithm is highly volatile and unpredictable, you wouldn't want a high leverage ratio. Your risk tolerance, essentially, is a key part of this process. If you're comfortable with more volatility, potentially higher risks, you might be able to use a higher leverage, but it comes at a price. If your algorithm is more conservative and predictable, you could manage with lower leverage. There are strategies where a lower leverage ratio can be better, even if it gives you fewer returns initially. You have to balance the potential for large gains against the risk of significant losses.
So, understanding the algorithm's characteristics, the expected return, and your personal risk tolerance are all crucial factors when setting the leverage on a trading platform like OANDA.
Exactly. You want to find the leverage that aligns with your strategy and your comfort level. It's not a one-size-fits-all solution. It's crucial to look at the specifics of your particular algorithmic trading strategy and carefully consider your risk tolerance before selecting a leverage ratio.
All right, so we're now on step 2, setting up the hardware, specifically creating a DigitalOcean droplet. Can you walk us through what a DigitalOcean droplet is and why we need one for algorithmic trading?
Sure, Matthew. A DigitalOcean droplet is basically a virtual server you get from DigitalOcean. It's a pre-configured, ready-to-use environment. Think of it as renting a computer on the cloud. We need this for our trading algorithms because they need somewhere to run. We can't just run them on our laptops. They need dedicated processing power, storage, and a stable network connection. Droplets provide that.
Okay, I see Figure 10(9), which shows the DigitalOcean droplet options. There are different plans available: standard, general purpose, CPU optimized, memory optimized. What are the key differences? And which one should we potentially choose for algorithmic trading?
Well, the crucial factors are the CPU, RAM, and storage, along with the networking bandwidth. For algorithmic trading, you often need a balance between CPU power for calculations, enough RAM to hold large datasets and running algorithms, and decent storage for keeping the data. The general purpose plan often offers a good balance. CPU optimized is good if your algorithms heavily depend on CPU computations, whereas memory optimized is suitable if you're dealing with huge datasets. You'll want to carefully consider your specific needs in terms of data size and computational requirements. The plan you choose depends directly on the volume and intensity of the trades your algorithms will handle.
Right? You touched on pricing.
Exactly. The pricing varies based on the chosen plan and its resource allocation.
This makes sense. So essentially, we're setting up a dedicated cloud server for our trading algorithms to execute on, optimized for its computational needs and financial considerations. Thanks, Yves.
Glad to help, Matthew. This is crucial for algorithmic trading. It provides a reliable, scalable, and cost-effective way to run our complex trading strategies.
All right, Yves, we're diving deeper into setting up the Python environment for algorithmic trading. So, we're looking at installing packages on a droplet, right? Can you walk us through this process? What's the significance of these particular packages that are being listed, like MKL_FFT and NumPy base?
Yeah, absolutely, Matthew. Setting up the environment is crucial. We're essentially installing the necessary software libraries that Python needs to run our trading algorithms effectively. Those packages you mentioned, MKL_FFT and NumPy base, are part of a larger ecosystem. MKL_FFT, for instance, is a library that provides highly optimized fast Fourier transforms. These are vital for certain types of technical analysis and signal processing, things like detecting patterns in price data or analyzing market volatility. NumPy is the foundational package for numerical computing in Python. NumPy and its associated libraries like NumPy base, which often contains extra modules, form the bedrock for many mathematical operations, array manipulation, and calculations we use in trading algorithms. It essentially provides the building blocks for many other libraries we'll use for algorithmic trading.
Okay, so these libraries are not just random packages. They're specifically chosen for optimized performance in the context of algorithmic trading. What about the other packages being installed, like BLAS, IntelliOpen, and libfortran? What roles do they play?
Exactly. Those are lower-level libraries providing crucial computational underpinnings. BLAS, for example, is a fundamental linear algebra library. It's a core component for many numerical computations, including matrix operations, which are absolutely necessary for a lot of our trading strategies. IntelliOpenMP is an optimizing compiler that can significantly speed up computations on multi-core processors, crucial for when you have many computations to run, or you need to run many simultaneous strategies, that kind of thing. Libfortran is a Fortran compiler which plays a role in some computationally intensive tasks that might use Fortran libraries, which are quite common in scientific computing and other areas of financial engineering. They're often optimized for the specific architectures on which they're running, making computation more efficient.
Got it. So, we're talking about a layered approach to optimizing performance, building on fundamental libraries like BLAS all the way up to more specialized packages like MKL_FFT for specific analyses. That's a very important concept. Now, can you explain the step where it says downloading and extracting packages? Are there any best practices for managing these downloads?
Right, that's the crucial installation phase. The crucial part is ensuring you have a stable and reliable internet connection during this time because the downloads can take time. The process is straightforward. They download the required libraries and then unpack them for use.
Excellent. So, we're building a foundation for our algorithmic trading strategy by carefully selecting and installing necessary libraries. This setup ensures our algorithms are both reliable and performant. That makes a lot of sense. Yves, thanks for breaking down those technical details. Welcome back to the show, Eve. We're diving deeper into Python for algorithmic trading, and today we're specifically looking at the uploading phase. So, we're on step 4, uploading the Python scripts and config files. Can you walk us through that process, focusing on the code snippet in Figure 10.12, please?
Sure, Matthew. Uploading the Python scripts, like automated_strategy.py, and the configuration file with account credentials, is a crucial step. It's essentially getting your trading logic and access details onto the system where the algorithm will run. As you see in the image, we've got automated_strategy.py, which, from the file name, we can guess holds the core of the trading strategy.
Right, the trading logic. So, what's particularly interesting in the code snippet is the use of 0MQ for socket communication. What role does that play and why is it important?
Well, 0MQ, or ZMQ, provides a high-performance message queuing system. It's used here to set up socket communication, specifically as a publisher. This means the script can send messages to other systems or components for monitoring or data dissemination. This particular setup has the script bind itself to TCP port 5555.
So, it's a way of the trading algorithm communicating with other parts of the system. For example, a monitoring tool?
Exactly. Imagine the trading algorithm making a trade. Using 0MQ, it can immediately send a message about that trade to a monitoring system, for example. This kind of communication pattern is vital in real-time algorithmic trading systems.
Okay, I see. And the line algorithm equals pickle.load open algorithm.pkl rb. What's that doing?
That line loads a persisted algorithm object. It means the algorithm's state, the model, any learned parameters or settings, have been saved to a file, algorithm.pkl. Now, this is a very common practice in machine learning applications to save and reload trained models. So when you start the algorithm, it quickly loads its learned state from the disk instead of having to retrain it every time.
That makes perfect sense. The with open log_ file, w, as f, part of the code. What is the significance of this block?
It sets up a log file. You see log_file equals automated_strategy.log, which defines where the log will be kept. Inside the with block, the code writes a header and the current timestamp to the log file. This is essential for tracking the algorithm's execution, including error messages or important events. It's a key component for debugging and monitoring.
Very good. So, in short, uploading the files gets the strategy, the stored algorithm, and the log setup ready for the real-time trading environment, enabling communication with monitoring systems and making sure crucial data is recorded.
Exactly, Matthew. That's the fundamental idea behind this step in the automated trading workflow.
Welcome back to the show, Yves. We're diving deeper into Python for algorithmic trading, and today we're looking at how to execute trades. This chunk gives us a visual, the figure, of the Python script in action. What can you tell us about what's happening here?
Right, Matthew. We're seeing a Python script initiating a trade. Specifically, it's executing a market order. We can see the details of the trade logged, like the order ID, the time, the instrument, and the units traded. The script is communicating with a trading platform.
So, a market order. That's important. Can you elaborate on what a market order actually is and how it contrasts with other order types?
Absolutely. A market order tells the trading platform to execute a trade immediately at the best available price. This is the most straightforward order type, but it doesn't guarantee a specific price. It's based on the current market conditions. Other order types, like limit orders, set a specific price you're willing to buy or sell at. And then there's stop-loss orders, where the order only executes if the price hits a certain level. So market orders are quick and responsive, but can be volatile if the market moves rapidly.
Okay, I see. And the figures show some key data points, like the price, liquidity, commission, those kinds of things. Can you unpack some of this for us?
Sure. Price shows the actual execution price. Liquidity reflects the amount available at that price. The commission is the fee charged by the brokerage platform for executing the trade. There's also a guaranteed execution fee, half spread cost, and financing. These represent various costs associated with the trade execution. The figures also outline the account balance before and after the trade.
So, we're seeing the impact of these fees on the final account balance. That's insightful. Now, this mention of going neutral, what does that mean in the context of algorithmic trading?
Going neutral indicates that the strategy is adjusting its position to offset or reduce risk. The script is opening a position in the opposite direction for the same instrument, euro to US dollar, but with a negative quantity to cancel the previous trade.
That makes sense. So the script's dynamically adjusting based on the market conditions to stay in a balanced position. Is there any code snippet we can extract to see how this happens in the Python script itself?
Unfortunately, there's no code provided, only the output of the code. We can only speculate on the code's internal logic by examining the output and other elements in the context, but with just the output, it's not possible to provide a comprehensive explanation of the code.
Okay, understood. So overall, we're seeing a pretty complex process here, with an algorithmic trading strategy interacting with a trading platform, executing market orders, managing account balance and risk.
Precisely. It's a lot to keep track of, highlighting the intricate nature of automated trading.
Excellent. Thanks, Yves. This has been very helpful for understanding the mechanics of the process. Welcome back to the show, Yves. We're diving deeper into real-time monitoring in Python for algorithmic trading. And this chunk is particularly interesting. It's about locally monitoring what's happening on a cloud instance, right? Can you explain that concept for our listeners?
Absolutely, Matthew. We're talking about a crucial step in algorithmic trading, getting real-time feedback on your trading strategies running in the cloud. Essentially, the idea is to have a local script that's constantly monitoring what's happening on your cloud-based trading instance.
So, you're saying there's a connection? A link between the local script and the cloud instance?
Exactly. You need a connection, often a socket connection, between your local machine and the cloud server. This allows your local script to receive data streams in real time about what's occurring on the cloud. The script in the figure, is crucial for that real-time communication.
In this data stream, you've shown some data here. What's going on with these numbers? Are these the results? What do they represent?
Right. Those numbers represent the data your trading algorithm is generating on the cloud. It appears to be a huge amount of features related to various aspects of the trading strategy. There are values for lag times, the return_lag, and max_lag columns.
So, return_lag and max_lag. They seem to reflect how long it's taking for the results of trades or calculations to come back. And what about the other columns? Which ones are these?
These other values, well, they represent, a huge range of indicators and features specific to your trading strategy. They're the inputs and results that feed into your trading algorithm's decision-making. You've got things like pricing data, order book information, market conditions, all kinds of crucial information for evaluating the market.
So, this table with all these data points, is this the actual output of the algorithm running live?
Yes. This is a sample output. In practice, this data is coming in continuously as the algorithm runs in the background. Figure 1015 shows the local monitoring script receiving these data points.
Okay, so the script is not only monitoring the data, but it's also interpreting it and potentially acting on it. That's where the no trade placed message comes into play, isn't it?
Exactly. The script is analyzing the data, and if it meets certain predefined criteria, a trade signal perhaps, it initiates a trade execution or any relevant action in your trading system. The no trade placed message indicates that no trade was executed based on the observed data at this particular point in time.
That makes perfect sense. So, real-time monitoring is about continuously checking data, making decisions, and, crucially, not just monitoring but also taking action based on that monitoring, right?
Precisely. This allows you to react to market conditions in a dynamic way, adjusting your strategy in real time.
Great, thanks for clarifying this, Yves. That's a very helpful overview. Welcome back to the show, Yves. We're diving deeper into this chapter on deploying algorithmic trading strategies, specifically using machine learning for prediction. So, capital management based on the Kelly criterion, that's a crucial element, right? Can you unpack that a bit for our listeners?
Absolutely. The Kelly criterion, well, it's a way to determine the optimal bet size in a series of independent trials. It helps you maximize long-term returns by finding the right balance between risk and reward. Essentially, you're calculating the fraction of your capital you should risk on each trade to achieve the maximum possible growth. It's not a guarantee, but it's a solid framework for managing capital in algorithmic trading. It's a foundational element for risk mitigation.
That's interesting. So, this goes beyond just picking the right algorithm? It's about making sure you use the algorithm responsibly.
Exactly. You have to account for the uncertainty and the potential for losses. The Kelly criterion helps you understand the expected return and the risk involved, helping you set your position sizes intelligently, maximizing gains and minimizing potential downsides.
Excellent. And you mentioned vectorized backtesting for performance and risk. Can you elaborate on that?
Sure. Vectorized backtesting is a key optimization step in algorithmic trading. Instead of running the algorithm step by step for each trading day, you do the calculations for all the trades in one go. This method is far more efficient than iterative methods, especially when dealing with large datasets. This dramatically reduces the execution time for backtesting, allowing you to examine a wider variety of strategies and parameters effectively.
So, it speeds up the entire process of evaluating the strategy's performance under different market conditions?
Precisely. It's absolutely essential for evaluating complex strategies that might need thousands, even millions of simulated trades. You get a much clearer picture of how your strategy will perform over time, considering potential risks and returns more comprehensively.
Now, transitioning from offline to online trading algorithms, that sounds like a crucial bridge.
Absolutely. This is where a lot of the practical challenges come in. You need to transform your offline models, which have been built and validated in a controlled testing environment, into algorithms that can adapt to live market conditions. You need robust code that can run in real time and handle the dynamic nature of the market. You also need to ensure your algorithm can handle the latency involved in real-time trading.
And you mentioned RESTful APIs, simplifying the automation process. Can you elaborate on that?
Yes, using APIs like the one from OANDA with Python libraries like TPCoA really streamlines the process.
Finally, logging and monitoring during deployment. That seems critical for post-mortem analysis.
Absolutely. Detailed logging and monitoring during deployment is crucial. You're observing how the strategy reacts to live market conditions, potentially encountering unexpected situations that you weren't able to anticipate during testing. Proper monitoring helps identify issues and refine strategies in a dynamic environment.
Yuv's fantastic insights. This is truly a multifaceted area. Thanks for the deep dive into algorithmic trading strategies and deployments. That concludes our discussion today on Python for algorithmic trading. A great summary of the key takeaway from this chapter is its focus on risk mitigation, streamlining processes using existing tools, and understanding that real-world trading requires adaptation and monitoring.
Thanks for having me, Matthew. It was a pleasure.
And to our listeners, thank you for joining us. Be sure to subscribe and tune in next time for more insights into the fascinating world of algorithmic trading. Have a great day.